back with part 2 of the OBBBA, One Big Beautiful Bill Act that was passed on July 4th and signed on July 4th. My first episode on this, episode 47, focused on the individual side because there was a lot of changes for that individual side. And this part 2 for the OBBBA, make sure I got all those right, OBBBA, because again, it's too long of a name to say every time, so we're shortening it, and that's what they're calling it, is on the business side of things. There are different compliances that have either come to light in the sense of new compliance or extending those that would have expired from, remember I said in the prior episode, there was a tax law passed in 2017, also under the Trump administration, that had things expiring in 2025, and then current bill that just passed and was signed into law under the second Trump administration. Some of these things extended those expirations. Some of the stuff, again, for businesses will be started now in 2025. Others won't start until 2026. So I just wanted to give you some insight and go over everything. My goal is to give you the facts based off of what I'm learning right now and what I have with relation to the facts. I'm not going to put in my own opinion whether or not I agree with the actual tax law, but I am going to give you the facts that relate to the actual tax law. And where I'm going to start is something that majority of businesses do have typically in any given year, and that is related to depreciation of assets, of property that you have bought and that you owned, fixed assets, things like computer equipment, office equipment, leasehold improvements to maybe your business space, other things that are considered property purchase that could be depreciated for your business to create an expense. Now, depreciation is really spreading out that expense over so many years, but there are a couple of things that can be done to maybe get the full expense in 1 year of a particular item that you might have purchased in a particular year. So what I'm going to do is I'm going to go through and I'm going to give you the rundown, a little summary of that. And then I'm going to give you a little bit of quick summaries of some of the other things. And then I'm going to spend time on an area that I come across a lot, not only as myself as a small business owner, CPA, I've been doing this for 30 years, in my own business for 12 years, but helping clients themselves who are in small businesses. This is going to be an area that I think does affect almost everybody. And it is related to non-employees, vendors, independent contractors, gig workers, which is different than if you have an employee where you're paying them a contracted amount and then you are obligated to file, potentially obligated, what's called a 1099 non-employee compensation or 1099 miscellaneous form, or if not through you directly, there is a form for third-party payers, a 1099K. And I'm going to spend some more time on that because I think that's an area, especially for small business owners, that gets very confusing. And here's the thing with that, with the independent contractors, the non-employee, vendors, things like that. On their end, from the individual side or their business side, they're obligated to report all of their income. Whether or not they meet the threshold for you to file the particular tax forms, they're obligated to report all of their income and pay tax on their income. So I'm going to come from the small business side of it, of you giving them those tax forms, those thresholds, but I'm also going to talk a little bit about the individual side. And then that should really do it right now for the new tax law. As things get updated or changed, as I mentioned in my episode 47, there could be technical changes, there could be amendments to the law. Things like that will come through. I believe they'll have it maybe potentially through September. I did just hear the possibility of tax season itself not opening up until mid-February per the IRS commissioner to allow for time to adjust to all of these changes. That could change, but just know that tax season could be a lot shorter this year. So trying to get all your stuff in order as a small business in particular is very important to do before the year end. And as a side note, getting your books in order. If you yourself are so overwhelmed, hire somebody like myself that works with small businesses, helping them with their accounting and their transactions and getting them ready for tax season. So that was just a side note, but let's kind of jump right into it. And like I said, I'm going to start with the depreciation piece of it. And I have my notes over here because I want to make sure that I'm quoting things correctly. So where I'm going to start with depreciation is something called bonus depreciation. So up until 2025, when the tax law was passed in 2017, there was bonus depreciation that you could take extra on particular items that were put in service for fully expensing in the year you put it in. That kind of was started at 100% and it was reduced. I think in 2025, it's now at 40%. But they have in this new tax law expanded this and extended it now permanently to 100% bonus depreciation. Now, remember, permanent until or unless the law gets changed or amended. So right now you can take 100% bonus depreciation, which was reinstated for qualifying business assets. Those are the things you've purchased for the business that were placed into service after January 19th, 2025. That's very, very important. If you purchase, let's say, 2 or 3 laptops for your business and it was January 15th, you don't get the 100%. I think, like I said, it's at 40%. So it's really important to keep track of your receipts, code your assets properly as you're purchasing them. And what it does is it restores an immediate full expense to take in the year that you place it into service for eligible property. And that is something that is very important. It has to be defined. It is already defined based off of the current law, the 2017 law. There's working on, IRS has to really go in and say, do we still want it to be on these particular assets? So that is something you definitely can do research on as to what are the eligible properties for this 100% depreciation. With that, there is also something called Section 179. And what Section 179 does, it's a depreciation. It is a specific tax provision. It's been in the tax law for a long time, our Internal Revenue Code. It can allow businesses to immediately deduct the full price of any qualifying equipment or software in the year it is placed into service. In the year it's placed into service, instead of depreciating it over years. There are certain requirements, it's not based off of necessarily amount, but really the eligible property and when you place it into service in the year. So something to understand that is what it is. So prior to the current tax law, the deduction cap was at $1,220,000 limit for Section 179. What you need to do is you need to take that first before you can take any bonus depreciation. So you may end up taking everything as Section 179 for the assets you placed into service in the current year, and then bonus depreciation doesn't make a difference because you've already expensed it. So they're trying to say, let's see where we can fully expense it first, and then we're going to give you basically extra. In that regards. But you have to have taxable income in order to take Section 179 fully. You cannot deduct more than the profit that you're making on your business. So it's really important for that. The other thing is, like I said, it was expanded. Now the cap is up to $2.5 million with a phase out that begins at $4 million in business equipment investment per year. And of course, they get index for inflation, which starts in 2026. So those are two very important things as it relates to assets that you purchase for the business. Whether you can fully expense it under what's called Section 179, you go to that first. And then if you have other assets you've placed in service that qualify after January 19th, 2025, you may still be able to get 100% bonus depreciation on those items. So definitely something to pay attention to. Like I said, there's other expenses and deductions that play into a role with businesses. I'm going to have a link in my show notes to a summary so you can take a look at those. Another area that I do want to talk about is the qualified business income deduction. So since 2017, there is a 20% qualified pass-through deduction. It's called QBI, Qualified Business Income Deduction. They've made it permanent, this 20%. It is, there are limitations. There are some things with regards to it. What it basically does is allow certain business owners to take this 20% off of your taxable income. That 20% comes off of your 1040 return. So if you take a look, if you're in a small business and you take a look at your first page of your 1040 and you see something that says QBI or Qualified Business Income Deduction, and it's reducing your adjusted gross income before you determine your taxable income, that's what that is. So basically they say who is eligible. So sole proprietors, partnerships, S corporations, and of course LLCs that are either taxed as sole proprietors, S corporations, or partnerships. Who's not eligible? C corporations. So this is really trying to help the small business pass through entities. So this deduction was going to expire at the end end of 25, they have now made it permanent. So here I'm going to give you an example. So let's say you have net business income of $100,000 and you qualified business to take the deduction. You could potentially get up to a $20,000 QBI deduction on your personal return based off of the 20%. And of course, if there's any other adjustments to that, there are phase outs. With regards to that, and also any limitations if you get a W-2. So if you are an S corporation and you are a shareholder employee, remember, as a shareholder, if you are running the business, you're a single member shareholder, or you have 2 or more people, and you're the one doing all the work in the business, you're also an employee, you should be getting W-2 wages. So that could potentially reduce or phase out this 20% QBI. However, there are certain businesses that are called specified service trades or businesses, SSTBs, that could be phased out, reduce this deduction, phase it out completely, because they feel that while these businesses potentially could get a deduction, they're reducing what they get. So here's an example of some of them. Well, accounting. So for myself, I would have a reduction in the limitation or phase outs for any qualified business income, the QBI, health, law, actuarial science, performing arts, consulting, financial services, athletics, and brokerage services. But if you do some proper tax planning, you may be able to eliminate some of the threshold effect of how much of the QBI that you can take. It's very important to know that. It's also important why you should have somebody helping you with tax planning, like a CPA, financial advisor, things like that, because this is very important when it comes to your business, and also to reduce what your taxable income on your personal return could be. And like I said, there are limitations with W-2s. What they're saying is if your income exceeds any of the threshold amounts, which is the greater of 50% of your W-2 wages paid by the business, or 25% of W-2 plus 2.5% of any unadjusted basis of qualified property. So that's a lot of tax wording. I understand that the business side gets a little more tax wordy, but basically what it's saying is if you also have W-2 income, there could be a reduction in getting that 20% qualified business income deduction. So what is considered qualified business income? Well, your ordinary income from your qualified trade or business, allocable share of income from either a partnership or an S corporation, and of course, being sole proprietor, having a Schedule C profit. It does exclude capital gains, dividends, interest incomes, and guaranteed payments and wages. So they do take this into consideration. If you do have multiple businesses, you may be able to aggregate those and still get a qualified business income 20% deduction. So it's really important. It can help lower your taxes. You need to look at the entity structure to see how that affects it. Like I said, an LLC can file as S corporation, partnership, sole proprietor. So however you are listed, because an LLC is a legal structure. It is not a business structure, and that's very important to know. That is not a tax structure. It is a legal business structure. There are no separate tax forms or taxes with LLCs because you have to register at the state level, and that is why they have that. So the QBI or Section 199A, like I said, can be very important for individuals. And this 20% is now permanent, and that's a nice little chunk of change off of your tax return that you potentially could reduce your taxable income and the taxes that you may owe. It does not reduce your self-employment income. Now, remember, sole proprietors and partnerships pay self-employment tax. So it doesn't reduce the self-employment tax. It reduces your earned income individual tax. So you have to understand the difference between the two. So it's very, very important that you know that. Interestingly enough, just as I mentioned before, the SSTBs, those specialized service trader businesses, engineers and architects are actually explicitly excluded from this category. And regardless of your income, you can take the QBI. So even if you're a consultant, but you're an architect, you most likely can take the full QBI. Real estate professionals, insurance agents, and banks are not considered specialized service trade or businesses unless they fall under consulting or financial advisory. So that's something to note, very, very important. And then again, if you have mixed businesses, you have to separate your QBI, see where everything is, and then it could take an aggregate, because you could have a portion that is an SSTB or not an SSTB. So really, really important to understand that part of it. So, depreciation, qualified business income tax, those are things that are definitely important for you to be aware of. Like I said, there are other things that have come into play with this new tax law. I will have summaries of those. They're related to research and development, interest deductions, things for qualified opportunity zones, qualified small business stocks, and things like that. So definitely will pay attention to that for you with regards to that. So an area that I really want to spend time on, because like I said, I have been doing this almost 12 years. I've been working with small businesses longer than that. I've been in the business for 30 years. And across my 30-year career as a CPA and accountant, I have worked not only with small businesses, nonprofits, larger companies. I've worked for corporation. I've worked for government. So I have a wide range of experience. And this is an area, small businesses, because I myself am a small business owner, that I absolutely feel passionate about. I think it's important. And I think it's an area for small business owners that really need to understand. You might not agree to it, just like you might not agree to having to pay self-employment tax, but it's just part of running a business, and it's part of something that you need to know. So this is the area related to Form 1099, non-employee compensation, or miscellaneous. What is this? Well, here we have to take a little bit of a step back. When you are in a business, if you hire someone to be your employee, that is your employee. You have control over their wages, their hours that they work, their benefits. You control that structure. You pay them, you pay payroll taxes for them. So that is what is an employee. What is considered a non-employee? Well, I'll go over two, but they apply to all non-employees. So the first is a vendor. Well, what do I mean by that? So let's say you're in small business and you hire somebody to do your website. If that vendor that you're paying to do your website is a sole proprietor or a partnership, and again, if they're LLCs, but they file as either sole proprietor or partnership, you should be, and you are required to obtain what's called a W-9 form. So when you go and you get a normal W-2 wage job, you fill out what's called a W-4, so they know how much to take for taxes. Well, in the non-employee side, it's called a W-9. But here's the thing, you're not taking taxes. You're utilizing that form to get their proper name. What is their business structure? Sole proprietor, partnership, S Corp, are they LLC? And I mentioned S Corp because the form has it on there. But that's to let you know that you don't need to give them a 1099 form. It has their address and their EIN number, which is their federal tax ID or their social security number. And that is how you determine, that's one way that you have to determine, do I send them a 1099 non-employee comp form or miscellaneous form? The other is the threshold. So right now, the threshold is if you pay a vendor $600 or more during the year from either your checking account or cash, and then I'll explain why. Credit cards, you can pay them. Third-party vendors, you can pay them. But I'm just explaining with cash check. You are obligated to file the 1099. Now, most of them will be non-employee compensation. Some of them will be 1099 miscellaneous. One of the examples of a 1099 miscellaneous is if you rent your office space and the person or the lessor, the company you rent from is a sole proprietor or a partnership. And I'm not sure about the S corporation, but I do think it's definitely sole proprietor or partnership. You're obligated to send them the 1099 miscellaneous. And I know a lot of lessors, a lot of people that rent to businesses don't always like that. I've had given me a hard time, but we're obligated to send them the 1099. And that's why you need to know what kind of business they are, whether most of them will be this NEC form, some will be a miscellaneous form. So there's the threshold, the 600. The reason why I'm giving you this is because things have now changed. So what has occurred, and there's been a lot of this going back and forth, is After December 31st, 2025, so starting in 2026, that threshold is bumped up to 2,000. So what that means is when you are paying a vendor or a contractor or a gig worker and you hit that $2,000 threshold and they are either a sole proprietor or a partnership, you are obligated to file that 1099 form. Here is what I will tell you, because I know that there's a lot of backlash. I understand that a lot of things occur. A lot of times I have small businesses that hire vendors or contractors and they come back and say, well, I'm not going to be paying them the threshold. And I say, well, you should still get the W-9. It is such good practice to get the W-9 form. And two, whether or not you as a small business owner send them that 1099 form, that vendor, that contractor, they're supposed to show all of their income. It is not up to you, the business owner, to force them to show all their income. They are obligated to show all of their income. Whether they do it or not, that is not on you. What can be on you is if you do not properly file the 1099 when you meet the thresholds, then you could have a penalty. So it's really important as you, as the business owner, to have best practices. Obtain a W-9 before you pay any vendor or independent contractor or gig worker. Obtain the W-9 form. I am stressing this because I tell all my clients. I just took on a new client, brand new business, and one of the very first things I told them was, we're going to get this W-9 thing nailed down so that we have everything in order for anybody that you hire, any vendors that you pay that are sole proprietors or partners. And like I said, I've had people come across and go, well, I'm an LLC. And my response back is, okay, how do you file your taxes? Because an LLC is a legal business structure. It is not a tax business structure on how you file your taxes. Very important to make the differentiation. So that 2,000 threshold does not go into play until 2026, which means for 2025, anybody that has reached the 600 or above, you should send them the 1099 form. Now, why do I mention the whole credit card third-party processor? So this is something that has been kind of going back and forth. And what occurs is if you pay your vendors via credit card or through a third-party processor, you don't need to, unless it's cash, I believe, through the third-party vendor, you don't need to then file a 1099. Even if you meet the $600 threshold, it's really up to the third-party vendor, to the credit card company, to send out what's called a 1099K. Now, that threshold limit has been going back and forth for the last couple of years. It's really confusing. I say to my small business owners, that's why when you are recording your payments, you have to really track it as cash, check, credit card, or third party, so that if you then go to use a 1099 system, so if you have an accounting system like QuickBooks or Xero, you can set it up and then it can track it for you. And then it'll tell you what you need to pay or what you need to give for the 1099. So here's the thing. That threshold has changed. And here is what it says. So there is this $2,000 threshold. So what they're also saying is to avoid unnecessary 1099 preparation and aligning with the new requirements, while the reporting threshold is now higher for 2026. Of course, they're talking about the W-9. The threshold for the 1099K is kind of, changing. Again, it could change again for this. But you can't rely solely on that. You can't rely on that. So the interesting thing is, and I'm going to pull this up because I want to get the wording right, because I want to make sure that everybody understands what that means. So let me pull this up. And my apologies. Like I said, I want to get it proper for you. All right. So for 1099K, prior in the 2017 law, it was a reporting threshold of $20,000 or 200 transactions before 2024. For 2024, it was $5,000, and then it's $2,500 in 2025. So that's why I say this, because your vendors, your non-employee compensation, your independent contractors, if you've been paying them by credit card, third-party processor, and in 24 or in 25, they get a 1099K from the company directly, not from you, that is why. It will increase. So here's where it will go. It's basically saying, and the threshold for 2026 and thereafter was the $600. So in 2026, the threshold will go back to the $20,000 and over 200 transactions. And this is where it kind of goes back to what it was before the tax return of 2017, the Tax Act. So they're basically saying for 1099Ks, that threshold is going back up to 20,000. Now that doesn't occur until 2026. So for 2025, if you've paid a vendor via credit card or third-party processor at $5,000 or more, they will get a 1099K directly from those companies. If you paid that vendor, let's just say you paid that vendor $10,000, $5,000 came from your checking account and $5,000 was paid through credit card. You are only obligated to file that 1099 NEC if it is over the 600, and if it was from cash or checking. Well, you paid cash or check $5,000. So now you're obligated to send them only the piece that's related to the $5,000. The credit card company is going to send the rest of it. So here's the deal. You're going to probably get calls from vendors or non-employee contractors, gig workers to say, but you paid me $10,000 and now you're only reporting $5,000. And you can explain to them, well, based off of the current tax law, I'm only obligated to provide you with a 1099 non-employee compensation or miscellaneous if I've paid you by check or cash. Well, half of that bill was paid by check or cash. The other half was paid by a credit card company or third-party processor, and they are supposed to send you a 1099K. Now, that person's still supposed to report their $10,000. Whether they report it or not, again, is not your issue. Your issue is properly filing these tax forms. And I know I am spending a lot of time on this, but again, I think it is important for small business owners to understand. It is good business practice to obtain the W-9 form before you pay that vendor or non-employee contractor gig worker. And when you have those conversations with them, you just hand them the form. You can get it off of the IRS. If you use a QuickBooks or a Xero, you can send it electronically. I've done that for my clients through, I use Xero and QuickBooks. And through Xero, I send an email with the link and they go in and they fill it all in. And then when we go to prepare the 1099s in January, I should have all the information. You need to make sure you're keeping on top of that. That is something I provide for my clients. If you're working with a bookkeeper or an accountant or somebody that can help you, make sure they're going through your vendor list and they're obtaining all the W-9 forms and they're properly tracking it. Very important. Do not wait until December or January to do this. Do it now. If you have not been getting W-9 forms, do it now. Go back through to your vendors, send them the W-9 forms now. If it clearly states incorporated on the invoice, you could maybe get away with not sending it, but I would say best practice is to send it to all your vendors. I wouldn't send it to a Verizon or a Comcast or your utility company. Most likely, they're not going to need the 1099 form. I'm talking about if you hire, let's say, a plumber to do work and they're incorporated, but you're not 100% sure you have that W-9 in your file, I don't have to track it. If they're not incorporated and they're a partnership or sole proprietor, now you track it to give them this form. So it's really important. Again, the 1099 NEC and miscellaneous thresholds was $600. That has now been increased starting in 2026 to $2,000 for payments that you've made, and it gets indexed annually for inflation. So very important for that. It's important to track. So best practice is to get that W-9. If they give you a hard time about it, here's the kicker. You can say to them, well, I can still file that 1099 and then there's backup withholding. Meaning, if they don't give you the W-9 and you can't file a 1099 and you're still paying them, you can actually withhold backup withholding taxes so that you don't get penalized, that you're showing your withholding taxes and submitting those taxes. Because vendors that are in business for themselves, independent contractors, are self-employed. They are not paying payroll tax. It is very important. They are paying self-employment tax, FICA and Medicare, about 13%. That is, and I tell this to all my business clients as well, terminology matters. If you have not hired them to be an employee where you are dictating the hours, dictating the amount, dictating the benefits, paying them by check, and withholding taxes, that's an employee. If you are hiring them as a contractor, non-employee, meaning a vendor, an independent contractor, a gig worker, where the hours are kind of mutually agreed upon, the rate, I have a monthly contract fee for my clients. That is my rate. Some of them, like I said, the businesses technically are supposed to give me a 1099 at the end of the year. and hours, but I control it. I'm the one that controls the rate and the hours, and I work with. It's a contract. That's why contracts are so important. To have that. So those are the people. So the terminology matters. It is not payroll when you're doing 1099 work because you're not paying payroll taxes. And that's the reason why. So important to know this. And you have to be careful when you hire people as 1099 non-employee contractors where that line could cross, because if they end up becoming employees, meaning you're giving them benefits and you're now requiring certain time and rate, now they're employees. Now you got to do payroll tax. Very important. So you have to determine whether they're employees or non-employees, and you have to then get that W-9 form. It's just best practice. And I hammer this in, and I feel so strong about it. That's why I'm hammering this in. So it's really important to understand that. Like I said, I am going to go ahead and leave a slide in the show notes that talk about the business provisions. I know that the small business side of this podcast was a little more technical. When you're working with businesses, it is technical. I highly recommend that you talk to your accountant, your financial professional, even your tax preparer should understand some of these nuances. Enrolled agents, things like that. Feel free, if you want, you can set up a consultation with me, and I can at least do a consultation and walk you through this process of either understanding the new tax law or understanding the 1099 business. It really, I would love to hear your information on this. If you have any questions, you have any insights, you're not sure on something, feel free to email me at yfmpapodcast@yourfinancialmaven.com. You can also visit www.yourfinancialmavenpodcast.com. Click on the I want to hear from you button and leave me a comment there. If you do want to set up for consultation, you can go to actually my business website, www.yourfinancialmaven.com, click on prospective client, set up an appointment, and then we can talk about what the needs are, and then we could set up consultation for that. But don't wait till the end of the year to do some of the tax planning as it relates to this. The other thing I didn't mention, which is important, I did mention it on the individual side of the podcast, and I don't want to forget this, is talking about the tax on tips and the tax on overtime, which we know is a deduction and a credit. It's not reduction in taxes per se. You as the employer, so let's say you are the employer, and this can either be for your employees or even contracted workers. You have to track the tax, the tips, and the overtime more diligently. So please make sure you're paying attention to that. If you're using a payroll service, please ask them how they want the tracking done, how the tracking should be done. I don't know for 2025 if the W-2 forms or even the 1099 forms are going to be properly adjusted to show those amounts in order for that individual to potentially get the deduction. I know for 2026 it will definitely roll out, but again, that's part of your planning. So definitely do that. Continue to listen to me as I learn more and I take more classes on this subject. Things get adjusted. I will be doing more podcasts. Take a look and listen to the rest of my episodes. There's a lot of great information, especially for small business owners. But for now, I'm your financial maven. The purpose of this podcast is to provide general information on the subjects discussed. It is for educational, informational, and entertainment purposes only. You should consult your CPA, accountant, or tax professional for all of your specific financial needs or situations. I just love being able to provide financial education empowerment to everybody out there. And I would love for you to be able to support that too. And now you can. Click on the link in the show notes or at my website, www.yourfinancialmavenpodcast.com, and support the podcast. You might even get a shout out on one of our episodes. This episode was hosted, produced, and edited by Samantha M. Besnoff, CPA, and Your Financial Maven, LLC. Music was written, composed, and performed by my cousin, Dr. Daniel Shore.